You're listening to The Capital Table. Private capital markets have been evolving for many years, but never more so than in recent times. Take a seat at the Capital Table with leading experts discussing insights into the private equity and M&A worlds, and take away the knowledge you need to excel in a rapidly changing marketplace. We know this is one table you'll leave feeling full and satisfied.
Hello, everyone. Welcome to this episode of the Capital Table. I'm Steve Brady, partner with Witham and market leader of our transaction advisory practice, and excited to welcome good friend Mark Burkett, who's a managing director at Configure Partners. He focuses on the debt markets, and he's here to provide an update on the credit markets.
Thanks, Steve. Great to be here.
Before we jump in, Mark, and jump into the debt markets, tell us a little bit about Configure Partners.
Happy to. Steve, Configure is an 8-year-old investment bank. The firm was purpose-built to help clients manage all aspects of their capital structure. Our core service is debt advisory work, so helping clients raise debt and non-control equity for a range of reasons. But then we'll also help clients with amendment or other legal negotiations. And then for those clients who are perhaps in a bit more challenging aspect of their evolution, we can help them restructure their balance sheets. The firm is incredibly active. We currently have 15 deals in market and then another 70 in our pipeline that we're monitoring, and hope many of those will convert to new engagements over the next 3 to 6 months. I'm based in Chicago, but most of my 35 colleagues in our office in Atlanta.
Really impressive firm, Mark, and excited to team up with you on this discussion as we have on other discussions in the past. So let's move on to the current state of the debt markets. Tell us what you're seeing and hearing out there. Interesting times we're in.
It certainly is. As I mentioned, our firm is very active, and one of the benefits of that is we just have a wealth of proprietary data, and then we combine that with some more publicly published data, and it gives us a pretty good perspective. We just published our quarterly update on the financing market, and I'm going to pull 4 topics out of there that I think will provide a pretty good overview of where the lending markets are today. Those 4 are the impact of tariffs, competition in the financing markets, broadly speaking, leverage and debt capacity. And then the last one is around lender participation trends in our financing processes. On the tariff side, which, probably no surprise that's number one topic. For Q2, Liberation Day was the second day of the quarter. So we saw the full impact of tariffs really hit Q2. For the quarter, institutional loan volume was down 70% for both prior quarters, so Q1 of 25, as well as the same quarter for 2024. And so really, no matter how you measure it, tariffs put the brakes on loan activity. And we think it's really for the first half to 2/3 of the quarter. June, at the back half of the quarter, saw a little bit of a pickup. And then July volume has come back pretty well, such that volume in July in the institutional loan market was about twice for the month what it was for the entire quarter of Q2. So, pretty good recovery there. Tariffs aren't by any means, completely on the back burner, but lenders have adapted, and most are willing to be thoughtful in evaluating the impact of tariffs on a case-by-case basis. Where we're really seeing that is on an industry-by-industry basis. We do a survey of lenders every quarter, and we ask the question about, how they're evaluating tariffs. And, it's really on an industry-by-industry basis. And the 4 sectors that lenders identified as being sort of most concern or greatest focus as having an impact, being impacted by tariffs are not surprising. It was the auto sector, consumer products, retailers, and then building products. All in all, it feels like as we've come out of Q2 and are now into Q3, we've reached a bit of an equilibrium as it relates to tariffs.
So interesting overview, and absolutely mirrors what we've seen in the overall M&A market, almost word for word. So yeah, for our audience, interesting to see. Obviously, there should be parallels, but really the exact timing as you walk through the debt markets is what we've seen in M&A and on both the buy side and the sell side. Early part of the recovery being more sell side work, but I know recently, a lot of private equity clients getting deals under LOI and others, not just private equity. So pretty exciting.
Yeah, and I think in our pipeline we see that as well. It's still not back to full bore when it comes to LBOs, but we've certainly seen an uptick and we're really more on the buy side. So to your point, maybe a little bit of a lagging to the sell side work that you're seeing. We've definitely seen an uptick in inbound LBO opportunities that our clients are starting to pursue.
I think everybody thinks we're on our way back to normal. Of course, I think there's a uniform agreement. None of us know what normal means anymore, but moving on from tariffs, you mentioned the second topic, competition out there.
Yeah, and again, this has been a persistent issue for the last couple of years, but demand to deploy capital far outstrips the supply of loan opportunities for lenders. Again, in our survey that we run on a quarterly basis, the number of we saw a 10 percentage point increase from Q1 to Q2 in the number of respondents who said that there are just not enough loan opportunities. And so we're up to roughly 80% of lenders in Q2 saying that they just are not seeing enough deal flow. And it's pretty rare that we get a data point that's so universal among a relatively diverse group of lenders. What we're seeing is that imbalance is really driving competition. In the same survey, 60% of respondents said that Q2 was even more competitive than Q1, and Q1 was already a competitive quarter. And so it feels like the competition among lenders is only increasing. Maybe some of that increased deal flow that we just talked about will help soften that a little bit, but at least as we got to the end of Q2, competition was still running very strong. One of the places it's really manifesting itself, what we're seeing in our proprietary data is suggesting that spreads on our loans that we're receiving on proposals has come down about 35 basis points over the last year. And that's broadly consistent with the institutional data. Institutional data would suggest for the bigger loans, those spreads have come down even more. But I think one of the really interesting ways in our data that we're seeing how competition is manifesting has been around pricing spreads as it relates to use of proceeds. Historically, we've always expected an LBO financing to get better pricing than a financing for a refinancing or a recapitalization transaction. And I think lenders feel that when they're investing in LBO, they're deploying cash at the same time as a sponsor. There is a symmetry of information. Everybody is reviewing roughly the same information. And so lenders historically have been willing to provide more aggressive terms, i.e. cheaper pricing into LBOs relative to refis. In our data about a year ago, that premium for a refi transaction was anywhere between 75 and 100 basis points higher than an LBO financing. And in Q2 of this year, we saw that spread compress all the way down to about 10 basis points, somewhere between 10 and 20 basis points. So a pretty dramatic compression in spreads, which tells me lenders want and need to deploy capital. And as a result, they're being more aggressive in situations that historically have been less preferable to them.
That's really, really fascinating, insights into the, use of proceeds and that difference. Do you see that across the categories of lenders? So in other words, commercial lenders down to private credit, unitranche lenders, they all feeling the same way when it comes to that?
Historically, and I think this is still true today, that commercial banks have been more focused just on yes or no credit decisions, whereas private credit has been more willing to solve situations by spread, by pricing. And so if they look at a situation and think it's a little higher risk or a little lower risk, they'll adjust the pricing, whereas banks tend to focus more on just, do we want to do the deal or not? And if we want to do the deal, we're going to do it in a relatively tight band of pricing, regardless of the situation. So it's not 100% true, but I think it's more pronounced what we're seeing on the private credit side than on the commercial bank side.
Yeah, with that, I think your third category, you can talk about leverage and debt capacity and what's going on out there. Yeah,
it's, since SOFR ran up a couple of years ago, we've seen leverage fluctuate in a relatively tight band. It's been, maybe 2+ years now where leverage has really been in a pretty consistent band. And one side of that is, leverage is being governed by a borrower's ability to service the higher interest payments that have been caused by the run up in SOFR. So just, sort of the fixed charge math of can we service the debt with our cash flow? And you can look at leverage from just a pure multiple of EBITDA, but then you can also look at it from a loan to value perspective. And the loan to value is where I find the data a little more interesting. Go back a couple of years, and we were consistently seeing lenders willing to issue loans with a loan to value of 60, 65, or 70%. But today, market is almost universally 50 to 55%. And there's certainly some outliers, but most deals are in that 50 to 55% LTV. And half of the respondents from our survey, our lender survey, said that LTV was either the number one or number two area of focus for their credit committees. And so it tells you that LTV is a very important measure for lenders. And what I think is going to be interesting to see is if we do see a rate cut in the not too distant future. Even this morning, it looks like maybe the chance of that has stepped up a little bit. It's going to be interesting to see if the rate cut brings with it any willingness to push on LTV because companies can service more debt, or are lenders going to really try to hold the ground because they're using LTV more as a way to govern against what they view as some macroeconomic risk and just giving them more cushion for the business to fluctuate in its profitability. And so I think that's something we're certainly going to track if and when rates come down to see how lenders behave there.
Time will tell on the if and when rates come down. And certainly a lot about that in the news kind of on an ongoing basis, but you're right, the chatter seems to be increasing. So we'll see what happens in the fourth quarter.
Yeah, exactly. It's coming, hopefully.
Yeah, final topic, I think you had mentioned talking about, lender participation in your processes and the insights around that.
This is a really unique one, and this is something that you don't see in the public data. I think it provides some really unique insights to just how the private credit market has evolved over time. And so we track lender participation in our financing processes. So again, as a reminder, we're running processes to raise debt for clients. And so we'll contact a certain number of lenders and then receive term sheets from some percentage of those. And so, the first way we measure lender participation is simply conversion, which is the number of term sheets we receive divided by the number of lenders who we show the deal to. And, not unlike what we've seen in LBOs, on pricing as it relates to LBOs and refis, we've seen a similar dynamic as it relates to lender participation. So LBOs being a more preferred use of proceeds, we've historically seen higher conversion rates from lenders on LBO transactions versus refi or recap transactions. And even in Q2, that dynamic held, but what we did see was a roughly 50% increase in conversion rates on our refi and recapitalization transactions. So that tells me lenders are more willing to deploy capital into refis and recaps, despite them being the less preferred way to deploy capital. And it just tells me that there's competition out there and they're looking for opportunities to deploy capital. So willing to do deals that historically maybe they had said no to. And then, the other thing that we track is something we have a couple names for it, consistency or velocity. What we're tracking there is just, if we go back and look at the cohort of lenders that delivered the most term sheets on our processes, individual firms, so firm A, firm B, firm C, the top 10 lenders that were most frequently delivering term sheets in our processes a couple of years ago, where do they stand in our processes today? We're still showing them deals, but are they still submitting term sheets? And, it's in the lending market, you have every firm deals with its own challenges. Every lender deals with its own challenges. They may be going through a fundraising process. They may have be overweight in certain industries in their portfolio. Their credit committee just may have a sentiment that puts them at risk on or risk off at different times. And then you have new lenders launching into the market. And so as we run our processes and approach usually a similar group of lenders on every transaction, we have seen significant volatility in which lenders ultimately submit term sheets. Our conversion rates have remained very consistent. I think we're very happy with the number of term sheets we're getting from our processes, but which specific lenders those term sheets are coming from is very different today than what it was just a couple of years ago. And so I think what that tells me is the private credit market certainly is robust. I think it's continuing to grow. It's also, I think, increasingly efficient. but it's certainly not a monolith. There's not every deal fits every lender. And so we see a fairly wide range of appetites among lenders, and the sort of the nature of that appetite for an individual lender can adjust from quarter to quarter to quarter.
I certainly agree with that. And what we're seeing is, you say it's a robust market, and private credit, not to get into the history of how that has exploded since the global financial crisis, but
Yeah.
It's real player in the market, and in many ways dominating certain segments of it. And it's interesting how the big banks, there are many examples of them investing in private credit funds. So where banks have had to respond to the regulations post GFC, they're finding other ways to deploy capital into that segment.
Yeah, it feels like it's the announcements of new joint ventures or partnerships has slowed, but for a period of time there, it seemed like almost every week or every 2 weeks, there was another large money center bank partnering up with some asset manager to create a private credit competitor.
Yeah. Interesting stuff, and great walkthrough of what's going on in the market and those topics, Mark. I mean, your thoughts as we look into the back quarter of this year, how this is going to play out, your crystal ball.
Yeah, I appreciate the opportunity to be wrong, but we're no surprise, we're in a market that is desperate for some degree of certainty, and I say permission to turn on the M&A engines full speed. I feel like we've turned the engines up to 7 or 6 right now, but I think all of us would love to see those cranked up to 9 or 10 on the scale. We have business owners that want to sell. We have private equity that wants and needs to sell. We have private equity that wants and needs to buy. Investment bankers that need to launch transactions, and lenders that need to deploy capital. There's no shortage of demand to see deal activity pick up from all constituents in the market. And it feels like, we've got these positive trends that we just talked about a couple minutes ago, but it still feels like we're at a bit of a fork in the road. And which direction we go is going to be dependent on this next wave of economic data. And we saw some soft employment numbers and a rising PPI last month. And you get a little concerned that you have a few more challenging data points, and you could see the market continue in this period of some volume, but not enough volume that we just talked about. And then on the flip side, we just had Lowe's and Home Depot report really, pretty decent quarterly results. And that could be a positive sign for the housing market, which obviously bleeds into a lot of other industries. And it could just be a positive sign for the broader economy. And then, as we talked about, the chance for a rate cut this year. And so you get a couple of positive developments combined with a rate cut, and it can signal to the M&A market that it's time to start running. I think, based on what we're seeing in our pipeline, conversations with lenders, conversations with private equity, I'm optimistic that we're going to see the trend that you and I just talked about continue here in the back half of 25. I don't think we get to full speed in 2025, but if we have the benefit of some stability in the back half of the year and maybe a little bit of positive news, I think 26 could be really robust as people scramble to deploy capital.
Well, certainly, I personally agree with that. I think on all fronts, I think the momentum is there. It's going to take a little bit to get back to, and I'll use the word normal, whatever the new normal will be. But you start doing that and giving private equity confidence to take portfolio companies to market. And there's certainly a big inventory there. Valuation expectations need to align, and all these pieces of the puzzle come together. And I think the pieces will start falling into place as we go through the fourth quarter. And we're certainly all, those of us, at least almost everyone I talk with in the market, optimistic for 2026. I know we said that a year ago, but
yeah, we sure did.
We're in a better place now. So
I agree. We've got a lot of the conferences in the fall are going to be happening, and it's going to be interesting to get a nice check of the sentiment of all the market constituents in person over September and October to see how everybody's feeling.
Yeah, absolutely. Well, Mark, thanks for joining us on the Capital Table, and to our audience, thanks for listening in on the overview of the credit markets. Certainly an important piece of the puzzle, and we look forward to talking to everybody again on the next episode. Thank you.
You've been listening to the Capital Table. For more information, please visit withum.com. Thank you for listening.